This is a new video on managed exchange rates. So this is part of a sequence that's listed on the specification under the number 4.3.3, Interventionist Strategies Influencing Growth and Economic Development. Say what it is. So what do we actually mean by this term, managed exchange rate? An exchange rate measures the price of a currency compared to another. It measures how much foreign currency can be bought on forex markets with one unit of domestic currency. A managed floating exchange rate describes a situation where central banks intervene in forex markets to influence the exchange rate. Managed exchange rates are also known as dirty floats. This is because, officially, the exchange rate is floating. However, the exchange rate isn't determined solely by market forces because the central bank intervenes in the forex market and affects the supply and demand of the currency concerned. So officially it's floating, but really the central bank is intervening and it's trying to manage either or both the supply and demand for its own currency on forex markets. Because obviously if you influence the supply and demand for your currency on the forex market, you can also influence the exchange rate. So let's look at what central banks can actually do to manage an exchange rate. How can they influence the exchange rate so it either goes above or below what would naturally be a market equilibrium exchange rate? The first type of intervention in foreign currency markets that a central bank could do would be to intervene in a manner that shifts the demand for its currency on forex markets. So as you know, you've got, let's take the example of sterling, for example. Suppose the Bank of England wanted to influence the value of sterling. Well, sterling, as you know, is supplied by British nationals who need to sell sterling to buy the foreign currency needed to purchase imported goods, services, and to buy assets abroad. The demand for sterling is determined by, in the main, the demand for UK exports abroad. And also sterling will be demanded by overseas nationals who need to purchase sterling to buy UK assets. So if you have no intervention, the market comes into equilibrium just like any other at the level where supply equals demand. So the equilibrium quantity of currency traded would be Q1 and the pure floating equilibrium exchange rate would be ER1. Now let's suppose that the Bank of England isn't happy with that exchange rate and they believe it's too low and they would like the pound to appreciate slightly. What can they do to manage the exchange rate up? Well, obviously they can try and figure out a way of increasing the demand for sterling on forex markets, because if they can do that, the equilibrium quantity will go up. But as you can see here, here's the desired appreciation that they were looking for. So we now need to sort of think about what the Bank of England could do to engineer this increase in the demand for sterling on forex markets. So I guess the first thing that you could do is raise interest rates. International investors who've got spare cash will always look for the best rate of interest on offer, and that might be rates of interest abroad in other countries. So if the Bank of England increased interest rates, wealthy foreigners might take their money out of dollars and euros or any other currency that you can think of, sell it and move it into sterling to take advantage of high British interest rates, theoretically speaking. So if you did that, there would be what's called a hot money inflow into sterling. Hot money is internationally mobile cash that's invested for very short periods of time, and it's basically after the highest rate of interest that it can get. Just like you, if your granny gave you £1,000 and she said she put it in a bank, which bank would you put it in? Well, answer is the one that would give you the highest rate of interest. In today's globalized world, investors will seek out the best interest rates all over the world. That's one of the aspects of globalization, internationally mobile capital. So if you put the interest rate up, that should attract hot money into sterling, and that could create this appreciation that you're looking for if you want to run a managed exchange rate that kind of appreciates your currency unnaturally. The second thing that you could do is you could instruct the Bank of England, the UK central bank, to sell foreign currency reserves. So the Bank of England will have US dollar foreign currency reserves, euro currency reserves, Japanese yen currency reserves. So what they could do is sell those dollars, yen and euro, and then with the proceeds they could actually buy sterling. This is beyond A-level economics, but it's always been something that I've been quite interested in. Where do central banks get their foreign currency reserves from? The answer is that they just get the Treasury to issue a foreign currency denominated government bond. So, for example, if the British government was running out of American dollars as a foreign currency reserve, what they could just get the Treasury to do is to issue some UK government bonds, but denominated in dollars. So anyone that wanted to buy these pieces of paper called UK government bonds, that the price would be in dollars. So the Bank of England would receive the dollars that it needs when it sells the paper. The downside, I guess, is that when the interest is due on those UK government bonds that are denominated in dollars, the Bank of England will have to pay the interest that's owed to the bondholders in dollars as well. The second way of managing an exchange rate is through intervention that works by shifting the supply of your currency on forex markets. So again, we've got the free market floating exchange rate. The government doesn't like that. The central bank doesn't like it. Whoever, policymakers don't like it. They want to do something about it. They would prefer a stronger currency, let's say. So what they need to do is to make that a reality by decreasing the supply of sterling on forex markets. If they can do that, they'll get the exchange rate appreciation that they're after. So what could central banks do to artificially decrease the supply of their own currency on forex markets? Well, the first thing is that the government could introduce foreign currency controls. Foreign currency controls are laws that prevent or restrict the amount of sterling that UK nationals are allowed to sell into forex markets every year. So if you reduce the amount of sterling people can sell, that will decrease the supply of sterling and force the exchange rate up. This might sound far-fetched, but this even happened in Britain in the 1970s. So there were laws about the amount of pounds that you were allowed to take out of the country, because obviously what they didn't want is Brits to go abroad with suitcases full of sterling, sell it abroad and buying French francs or German Deutschmarks, because that would have led to a big increase in the supply of sterling and therefore a depreciation that the government and the Bank of England didn't want at that time. So to stop it, they just put foreign currency controls in, which limited the amount of sterling people were allowed to take out of the country to swap for Spanish pesetas, say, when they wanted to go on their 2-week holiday to Spain. Obviously, this was not a very popular policy with the UK households, and some people tried to break the law. But obviously, like any laws, it needs to be enforced, and there needs to be fines for people who are caught taking money out of the country. I dare say even today there are types of foreign currency control. So, for example, if you rocked up at Heathrow Airport with maybe I don't know, 20 gold sovereigns, maybe a few £1,000s worth of coinage, I'm sure the customs officials would ask you what you were doing with that money and where you were taking it to, and it's almost acting as a foreign currency control. The second thing that you could do is try to decrease the supply of sterling by imposing capital controls. Capital controls are a basic infringement of private property rights. So it's laws that prevent UK nationals from selling their own assets. So an easy way of doing that is you just shut the stock market down, or you close the banking system. Because if you stop households from selling assets, you'll also be able to stop them from swapping the proceeds of those asset sales out into foreign currency, therefore restricting the supply of currency, sterling, on forex markets. The final thing that you could do is just issue less currency, which the Bank of England subsequently sells on forex markets. So if they just issue less currency, sell less sterling on forex markets, that would also help to elevate sterling at a level that would be above a truly free market floating exchange rate. See why it might work. So what we'll look at here is the advantages of running a managed exchange rate. How could it create growth? How could it create development? So we'll think about possible reasons why policymakers might choose to run an overvalued managed exchange rate. Well, as you know, a strong currency reduces the price of imports. So that could be one reason. You deliberately set out to run a managed exchange rate that's above the free market floating exchange rate, because the stronger your currency is, the lower the price of the goods that you import. And that could be important if you're importing things like oil or food. It could help to improve the standard of living of the poor, who maybe spend quite a lot of their income on food or petrol, diesel, heating oil, etc. So you could try to fix the exchange rate at an artificially high level as a way to reduce the price of essential imports. A second possible reason why you might choose to run an elevated managed exchange rate is to reduce government spending on dollar-denominated debt interest. So this one's a little bit complicated, so if we explain it, governments default on their national debts when they fail to pay the interest that's due to the bondholders. So governments that have defaulted on their debts in the past are not very popular with the bond market for obvious reasons. So what tends to happen is that if those governments want to borrow again in the future, they normally have to issue government bonds in a foreign currency. The reason for that is that that government doesn't hold the keys to that particular printing press. So you might have, I don't know, the government of South Africa or Argentina. They've had a very, very, very poor record on defaulting on their poor old bondholders. So they want to run fiscal deficits, so they need to sell new bonds. But no one will want to buy Argentine government bonds that are denominated in pesos, a currency that the Argentine central bank can just print at will. But Mr. Bond might buy bonds from the Argentine government if they're denominated in a foreign currency that the Argentine central bank can't print, like US dollars. So this is a very common issue for developing countries. Many of them have defaulted in the past. Many of them still want to run fiscal deficits. So many of them are still issuing bonds. But they have to issue those bonds in dollars or euros or some other currency that they can't print. Now that also means that every year when Mr. Bond gets his interest payments, those bond interest payments are also in a foreign currency. So if it's a US dollar bond, Mr. Bond will get his interest payments in dollars. If it's a euro denominated bond, the interest will be paid in euros. So from a developing country's perspective, if you've got a lot of, say, dollar or euro denominated debt interest, you'll want to fix your exchange rate artificially high against US dollars or euros, because it will reduce the amount of taxation you'll need to collect every year to pay the dollar denominated interest payments. Say why it might not work. So what we'll look at now is why it might not be a great idea to try to run an overvalued managed exchange rate. The first one is that if you run an overvalued managed exchange rate, it will damage your international price competitiveness. The reason for that is that the stronger your currency is, the higher the price of your exports and the cheaper your imports will be. So if you've got an overvalued currency, in all probability you'll probably end up running current account deficits, and it will be very difficult to get short-run growth by creating increases in the net exports component of aggregate demand. As we saw, to maintain an overvalued managed exchange rate, you'll need to jack your interest rates up to create the hot money inflows needed to suspend your currency above where the free market would have it. Now, there is obviously opportunity costs of using tight monetary policy to create an overvalued currency. And the most obvious ones, I guess, would be that high interest rates might discourage investment, which would slow productivity growth, which would slow the long-run trend rate of growth. High interest rates might also cause pain, especially if households are carrying a lot of debt. It might slow the rate of growth of consumption, and again, that will slow AD growth, and Keynesians think that that's really important, because if AD growth slows, then you'll get less short-run economic growth. So, changing track slightly, what we'll look at now is why policymakers might want to run an undervalued managed exchange rate. A good example of this is China. So this wasn't just Trump, it was also Obama before him. They've both been on TV and smeared China for unfairly running a managed exchange rate. Officially, the Chinese yuan floats, but US presidents, as I say, they say, well, what China's actually doing is running a managed exchange rate, and that managed exchange rate is holding the Chinese yuan at an artificially low level compared to the US dollar. And as you know, if you keep your exchange rate low, you'll reduce the price of your exports. If you reduce the price of your exports, the demand for your exports abroad will extend. That should lead to an increase in export income and therefore create export-led growth. So that could be one reason why you want to run a managed exchange rate that deliberately undervalues your currency, because you want to try to promote export-led growth, and a weak exchange rate will help to reduce the price of your exports. So we could illustrate this on a diagram. So you could imagine the Chinese economy in equilibrium at MY1 because the level of aggregate demand is stable at AD1. So the Chinese government, they decide that they want to create economic growth. So to do that, they'll need to increase aggregate demand. So if they can increase aggregate demand from AD1 to AD2, they'll get their short-run growth that they want. So how they're going to increase aggregate demand? Answer is via the X minus M component. If they deliberately undervalue the yuan, they'll deliberately make Chinese exports artificially cheap, so people abroad will go off and buy them, and that will increase China's export income. At the same time, deliberately undervaluing your currency will also make import prices higher than they otherwise would be, and that will choke off the demand for imports, reducing import expenditure. So if you combine those two things together, rising export income and falling import expenditure, you've got the current account moving towards surplus, which basically means the X minus M component of aggregate demand will become increasingly positive, and that's where you get the aggregate demand growth needed for short-run growth. You could also argue that running a managed exchange rate that is artificially suppressing the value of your currency below kind of fair market value, it could be useful if you were trying to diversify and do that by industrializing. So it could help your infant industries to successfully export if you're running a managed exchange rate where your exchange rate is artificially weak, it will mean that this infant industry has got a competitive advantage because a weak exchange rate reduces the price of exports. So this is the same point or an extension of it. You could argue that, if you want to escape primary product dependency, you need to industrialize, you need these thriving infant industries to give them a chance of being able to compete. Maybe you need to hold your exchange rate underwater by managing the currency, managing it to a level that would be below the level that would arise if the exchange rate was just left to find its own equilibrium according to the relative strength of supply and demand on forex markets. Say why it might not work. So here what we're going to look at is the potential problems that a country could come across if they run a managed exchange rate that suppresses the value of their currency. The first one is retaliation. So for example, China's got whacked by Trump. China has been accused by Trump of deliberately undervaluing the Chinese yuan. And Trump's basically cried, not fair, and he's not going to allow China to steal America's domestic market through an artificially weak Chinese yuan. So what can happen is maybe you go to the World Trade Organization, you try to paint out China, in this case, as being a currency manipulator, and you maybe say to the World Trade Organization, this isn't fair, so what we're going to do is impose tariffs on Chinese exports to America in retaliation. Or maybe what you do is just say, we'll instruct the Federal Reserve to cut interest rates and see if we can weaken the dollar against the yuan. And that's called a currency. What emerges there is what's called a currency war. So the Chinese cut their interest rates, hot money flows out of the yuan falls against the dollar. So the other way of looking at that is the dollar's appreciated against the yuan. So the American president says, well, what we need to do is get the value of the dollar back down. So they instruct the Federal Reserve to cut US interest rates. Hot money flows out of the dollar back into the yuan. So the value of the dollar falls. And so then what China might do is cut interest rates again. And you just get this like race to the bottom in terms of interest rates in this sort of currency war scenario. So this is what's been happening now for the best part of 10 years. And it's one of the explanations of why interest rates across the globe are at historic lows. Because interest rates have been used as the main weapon to fight currency wars. One country can try to gain an unfair advantage by deliberately vandalizing its own currency, but then other countries will just retaliate. So all that you end up getting is more or less every country on the planet running very, very loose monetary policy. Another problem of running a managed exchange rate that undervalues your currency is that weak currencies are bad for the poor, especially in countries where you're importing food, medicines, petrol, etc. Because a weak currency will increase the price of imports, and that will cause cost-push inflation, which will reduce the real wages of the poor. So a weak currency actually is not very good for Mr. and Mrs. Average. As I say, particularly in countries where a lot of the essentials are imported, because all of those essentials become more expensive when the currency weakens. Another problem of running a managed exchange rate is that if you're using monetary policy for currency management purposes, you can't use it for inflation targeting at the same time. You can either do one thing with monetary policy or another. So, for example, let's imagine that you wanted to use the monetary policy to run a managed exchange rate that was designed to lower the value of your exchange rate. So to achieve that, you'd need to cut interest rates. But if you do that, then what's likely to happen is import prices will rise and it will cause inflation, and maybe inflation goes above the inflation target. So if you wanted to bring inflation back down under target, you'd need to raise interest rates, which would mean that your currency would appreciate. So in practice, you've got to make a choice. You can either use monetary policy to target inflation, or you can use monetary policy for currency management. You can't use monetary policy to pursue an inflation target and currency management at the same time. You've got to pick one or the other. Say what it depends on. So some more evaluation. So one thing that you could look at, especially from a developing country context, is what's the objective of policymakers. So in some developing countries, the dictator that's in charge actually prefers a managed exchange rate that overvalues their currency, because what they're after is being able to buy toys like fighter planes from Russia or tanks from America, and a strong currency will reduce the price of those things when measured in local currency. On the other hand, if the objective of policymakers is I don't know, to promote export-led growth, then you'd maybe want to run a managed exchange rate that was depressing the value of your currency. So a lot of it depends on what the objective of the policymakers are. What are they trying to achieve? Are they trying to achieve a strong currency so that they can buy big boys toys at knockdown prices? Or are they wanting to manage their exchange rate to try to escape primary product dependency? Another say what it depends on factor is the issue of the national debt. Is it denominated in local currency, a currency that you can print, or is it denominated in a foreign currency? As I say, that's likely to happen if you've defaulted in the past, and Mr. Bond will only buy your government bonds if they're denominated in a foreign currency like US dollars that you can't print. So if you do have a lot of foreign currency denominated debt, then the likelihood is that you'll go for a managed exchange rate that artificially overvalues your currency. Now, you'll still have to pay the same amount of dollars every year to the bondholders, but if your currency is stronger against the dollar, because you're artificially trying to manage it upwards, that will reduce the amount of local currency that you'll need to swap in the forex market to buy the dollars that you need to pay the bond market. I guess the final thing to say as well is that much would also depend on your economic perspective. So for Austrian economists, they would be very much against the government and the central bank trying to intervene in foreign currency markets. They would be more in favour of just letting market forces have their say and having a fully floating exchange rate. Keynesians, on the other hand, they believe in government intervention, so they will be more likely to favour a managed currency or maybe an outright fixed or pegged exchange rate.